I approached this from my personal story, which is that I was finding it very difficult to actually collateralize my own personal investment in arbitrage funds and allow the bank to give me leveraged exposure to those arbitrage funds. The exact trade that I spoke about before with the S&P 500, I was trying to do with crypto arbitrage funds, regulated products. And so what I soon came to realize was that the world of tokenization and modular lending actually in DeFi were creating the conditions to allow for what might look like alternative asset financing on chain. And this is where 3F comes in, because what Sonya and I are building is a product to address this market. We're effectively allowing users to get leveraged exposure and therefore financing on alternative assets like crypto arbitrage vehicles and other alternative yielding products in one go, right? They get that exposure in one go. They get that financing in one go.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features a new protocol delivering a leveraged yield called 3F. This is a protocol that I think represents multiple themes that we've covered on the podcast. One of them is the convergence of DeFi and TradFi. Another one is tokenized liquid funds. And then the third is looping.
And I think one of the things you'll notice from this is the backgrounds of Romeo and Sonya perfectly tie into what they're building now with 3F. Sonya worked at Steakhouse Financial, and then Romeo worked with one of the biggest on-chain asset managers in the space, Abraxas Capital. We're basically running an Athena-style basis trade all the way back since, I think, 2018.
The key to understanding 3F is the access that they have available. This isn't about just integrating different DeFi protocols. There are relationships when it comes to the way they facilitate these bridge loans to create these leveraged yield positions. I think it's really important to understand that, plus the access to these liquid yield funds. The net result of what they're building is that on-chain investors are going to be able to permissionlessly get exposure to leveraged yields.
Romeo gets into this a bit. He's basically a practitioner that's just building tools that he wished existed. It's kind of a classic case of a founder setting out to just build something that they need.
So before we get started, just a quick reminder, you can subscribe at the-edge.xyz. That's the best place to subscribe to the Edge newsletter and to get real-time notifications for the Edge podcast anytime we release a new episode. You can also check out our link tree at edge_pod. That's the best place to subscribe to the Edge podcast on Spotify, Apple Podcasts, or YouTube. And then one last shout out to all of our sponsors that make the Edge podcast and the Edge newsletter possible. Sponsors like TOROS Finance and REDSTONE. Otherwise, we hope you enjoy the episode. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain Oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge Podcast and Edge Newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is currently live in private beta and will be opening for public deposits soon. Learn more at neutral.fi. All right, let's introduce Sonya and Romeo, co-founders of 3F. Guys, welcome to the Edge Podcast. How are you doing?
Good. How are you?
Very good. Why don't you tell us more about what were you working on previously, all the things you did at Steakhouse Finance? Would love to understand all the cool things you've worked on in the space.
Yeah, sure. So first of all, thanks for having me. And so Steakhouse, which was my former employer, I worked there for 2 years from 2023 till 25, where I've just offboarded back in July. And Steakhouse, a little bit about it, it began as a DAO advisory. It spun out of MakerDAO. It was the first group to start to think about allocating Maker balance sheet, now Sky, to RWAs. And they were real leaders in envisioning, DeFi convergence with TradFi. And this was quite a topical time because this was when, the bear market hit after FTX had gone bust and DeFi yields were much lower than treasury yields. So quite a topical thing to try and optimize yields for Maker balance sheet using tokenized treasuries. So that's sort of how it all began. But around the beginning of last year, Steakhouse pivoted from being a DAO advisory to MakerDAO and LidoDAO, and decided to expand its core competence by rolling out products. And our first product happened to be the Morpho Vaults. We were the first curator to partner up with Morpho to provide over-collateralized lending vaults to DeFi users. And, 18 months later, we're proud to say that, the TVL on Steakhouse Morpho Vaults collectively have exceeded 1.5 billion in TVL.
Do you have any lessons to take away from the success of Steakhouse? Because there are other curators in the space. There's others that are competing with the products that Steakhouse offers. They seem to be a standout. What are your thoughts?
So Steakhouse as an organization has tended to be more conservative. I think the lesson for all of us, if you've spent enough time in DeFi, is you win by surviving. And the first product that we rolled out was the Steakhouse USDC Vault, which is now the top vault on Morpho. It's got just under 500 million TVL. And the product was very simple. USDC lenders lend against BTC or ETH derivatives as collateral, and that's it. It's we might be able to call the closest thing to base rate in DeFi. And we started very conservatively and very vanilla, and it was just an easy product for people to be able to understand. And from there, we built up the risk curve. As investment products get more sophisticated, it just becomes a little bit harder and harder to sell to a big addressable market. So I think the success of Steakhouse really has to do with the fact that we started with a very simple product that all of DeFi could really understand very easily.
Yeah, and something that I noticed was Steakhouse just, I think, created a pretty sterling reputation. in maybe even a short time. I mean, I know there's roots in Maker, but I think maybe, is it Seb, I want to say, or who's one of the...
Yeah, Sebastian.
Yeah, that's it. Yeah, he was just writing some really good blogs, and you could just see like the thoughtfulness that was going into everything that he was doing. So that was like one of my takeaways was like, wow, people finally know what they're doing in DeFi. Like, we're finally getting some pretty good actors in the space, which was nice. I want to pivot a bit because we've got Romeo here as well, and Sonya, you told us a cool story, just like how you met Romeo. Maybe you can just kind of give us that again, because it was pretty interesting.
Yeah, it's a little bit embarrassing for me because I've been called a bit stalkerish, but I can elaborate here. So when Steakhouse was advising Lido, we wanted to understand who the largest stakeholders and token holders were in our ecosystem. So Steakhouse is really known for its Dune dashboards, and we ran a Dune query to understand the largest token holders of Lido staked ETH. And at the time, Abraxas, the Delta Neutral hedge fund where Romeo used to work at, appeared as one of the largest tagged wallets. I think they had, a few hundred million, and that's a really large single holder. And I had no idea who Abraxas was, so I made it my life mission that week to track down, people from Abraxas. And on the other side was Romeo, who I connected with on Telegram and just had a random outreach. So the official tagline is Romeo and I met onchain, and it, is kind of the next iteration of like meeting someone online.
Yeah, it's a lovely story. I mean, it's nerdy, but I love it. It's pure DeFi.
It's like a nerdy crypto Tinder, basically.
Yeah. Well, okay, Romeo, this is a good segue here. So tell us a bit about Abraxas capital management then, and maybe how you got started there and a bit of your journey there.
Sure. So Abraxas launched its crypto strategy in 2018, doing cross-market arbitrage on C5 venues. And I joined actually whilst I was at university in 2021 in the summer. I didn't know much about finance, have to be honest, but I was incredibly passionate about DeFi. And I joined the team expecting to see how the amazing, ARBs across SushiSwap and Uniswap and Kyber were happening. But to my surprise, the fund was only doing C5 arbitrage. So I joined the team and actually after a few months launched the DeFi strategy within the fund. And over my tenure there of 4 years until June of this year, I was incorporated into the portfolio management desk, and there was about a team of 8 or 9 of us managing what is now 3 funds with, I think, 4 billion they've reached to as of late. So awesome, really awesome company, doing amazing things, all within the Delta Neutral space. And yeah, that's the story.
That's a very modest story, by the way. So just to show Abraxas' track record a little bit more, they've been around since 2018. And this is all the stuff that I'm like going through real time, trying to figure out who Abraxas is, right? When I saw them on the Lido cap table. So they've been going since 2018 in the USD share class, not a single negative month. So month after month, they're, gaining positive, basis trades, and annual volatility of less than 5%. And guess what their annualized return has been since inception? 20%. So for those in TradFi, if you know the concept of Sharpe ratio, which is basically your return, divided by some notion of standard deviation or variability of returns, then the product is arguably one of the highest Sharpe ratio products in the world, to my mind.
I think for listeners who are, just hearing about this and hearing us explain this, in my view, it was Abraxas was doing something similar to an Athena style trade well before Athena, and I guess just not tokenizing it into, a synthetic dollar, keeping it more in like a fund. But those returns are incredible, obviously. Like if you can stack 20% yield over, since 2018, just absolutely phenomenal return. So yeah, anything more that you can share? Any more takeaways, maybe even from the DeFi side, once you kind of came in and brought things a bit more on chain, Romeo?
Sure. So up until I joined, they were doing centralized arbitrage, things like, spot arbitrage, basis trades, both on the perpetuals as well as term futures on the CME. And they were starting to emerge, some term futures on centralized exchanges like Binance and OKX and Deribit as well, and stablecoin arbitrage. But when we launched the DeFi strategy in 2021, I'm sure you can remember, yields were just basically like exploding out of this world. And you could get things like 30% yield on DAI, USDC, USDT pools on Curve. And so the operation at a time was just yield farming effectively, right? And leverage yield farming. So we would deploy some capital on the main chains at the time, collect this yield and immediately hedge out the farming rewards. Nowadays, actually, those yields unfortunately don't exist anymore. It's a little bit harder to make 30% on the 3 pool. Well, you just can't. But DeFi has become so much more liquid in certain ways that now the really interesting sort of arbitrage that you can do is not on the price of the asset per se, but on the interest rate. So you can borrow incredibly cheaply with really a lot of size on decentralized finance, places like Spark, places like Aave, places like Morpho. And you can deploy that cash in high-yielding strategies on centralized venues. And what this does is essentially provide a very low-risk, high-reward opportunity that a lot of these delta-neutral arbitrage funds are exploiting. And they're very sophisticated in their strategies. They have strong algorithms operating 24/7, team globally. So you can really optimize your portfolio in a way that is slightly, not slightly, substantially more agile and yes, optimized rather than a one sort of trade vehicle, which is that of, something like Athena or a Resolve.
Romeo or Sonya, what's your view on the appetite for institutional capital, serious capital, however you want to define that, coming on chain? We have BlackRock now with funds deployed on Ethereum. We've got, major fintech players like Robinhood that are going to be launching an Ethereum L2. There's lots of money on chain, especially when it comes to stable coins and other RWAs. But what else are they looking for in order to deploy more capital on chain?
Well, in my previous life, I was a fund manager, so I had some context from my fund manager friends. Actually, even in crypto, if you're, I believe, over 150 million in AUM in the US, you need to register with the SEC. And historically, the lack of regulatory certainty around, an institutional interaction with DeFi and on-chain activities had really curbed any material activity by, these funds who possess large amounts of capital. So I think with the current administration allowing, more regulation to be discussed and giving more guidance on how these things might be viewed, there is now, from what I hear, a greater appetite for these institutions to touch chain. And I think that's, really meaningful if you think that U.S. has historically had, the biggest amounts of capital. The likes of Abraxas had the benefit of being outside the U.S. jurisdiction. So it's not an exaggeration to say that U.S. had been, kind of like cut off from being able to touch chain when it comes to DeFi especially. So I think, I'm very hopeful that this trend continues. Of course, we don't really know what would happen under a new administration in 3 years' time, but I'm hopeful that this is kind of like the start of a structural trend, and more and more institutional capital will start to underwrite these opportunities, whether it be higher yields or lower cost of funding on chain.
Romeo, given your experience at Abraxas, you know how important or how popular looping is in DeFi. Talk to us about the state of looping in DeFi versus whatever equivalents we have in TradFi.
Well, in DeFi, the most famous looping trade is, looping the synthetic denomination of some asset with the underlying and essentially going leveraged long that underlying whilst borrowing. So going leveraged long the synthetic asset whilst borrowing the underlying. So the perfect example of this is staked ETH against ETH. And this is a trade that is done in hundreds of millions of dollars across all the lending markets. So users collateralize staked ETH on a lending market, borrow ETH, and then reinvest it in staked ETH. And whatever the difference in the staked ETH yield and the borrow rate is essentially the spread that you're pocketing in. And with each increase in leverage, you increase your effective yield, right? And another example of this that's become very famous over the last, let's say, 12 months is with the Athena PTs. You can fix a yield of an asset on on Pendle, and collateralize that in a lending market and borrow cash, let's say if it's Athena, and then reinvest it in the PT. With crypto, since everything is atomic, you actually have the luxury of using a flash loan. If you're sophisticated enough, you can code a bot and essentially draw a flash loan, which allows you to build the position in one go. Otherwise, you have to do what I do, or maybe what you do as well, Sonya, which is buy the asset, collateralize it, borrow, buy the asset again. If we're doing staked ETH and ETH as an example, stake it in ETH and then collateralize it, borrow ETH, stake it again, and collateralize it. This takes a lot of time, but because crypto assets are atomic, this works very well. In the real world, you can essentially do this because what we're talking about is just going leveraged long and underlying. And you can maybe buy an instrument. Let's say you want to buy the S&P 500 at the bank. Your bank allows you to do this looping trade, but you do it in one go. You ask the bank, can I have a 3x exposure on the S&P 500? And they extend you this flash loan internally in the bank, and you buy it, and they just immediately collateralize that position. This is not the same with alternative assets, or all alternative assets. Banks often have difficulty extending this facility. And alternative assets like RWAs on-chain cannot be flash loaned because they're non-atomic. They don't have instant liquidity or a secondary market where you can buy it. And so users are forced to recursively loop that RWA. And this is what we'll get into. I think the biggest problem with RWAs in lending right now is the problem of recursive looping. Because if you have a vehicle that takes 1 month to allow you to subscribe or unwind, or even just daily, but that settlement happens a day later, it can take you months or years to build a leveraged looped position, and months and years to unwind of that leveraged loop position, which is a terrible UX problem. And our thesis at 3F is that this is actually the biggest blocker for RWAs currently, and effectively matching the demand for leveraged exposure to these RWAs on-chain.
This episode is brought to you by Mantle, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, Mantle is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are two key things we need: deep liquidity and high yield.
To learn more, go to katana.network. As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's Syrup USDC and Syrup USDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and soon Aave. To learn more about Maple, go to maple.finance.
Maybe we just get into a bit more about 3F then. We've sort of set up some of the problems, and we've talked about kind of the two different worlds that you're coming from. So maybe one of you, maybe Sonya or Romeo, just explain even kind of deeper why there's a need for something like 3F in the market, and really what it is that you're building.
I approach this from my personal story, which is that I was finding it very difficult to actually collateralize my own personal investment in arbitrage funds and allow the bank to give me leveraged exposure to those arbitrage funds. The exact trade that I spoke about before with the S&P 500, I was trying to do with crypto arbitrage funds, regulated products, like my former fund that I was working at. But it was impossible to get these banks to extend you this facility. And they would come back with responses like, Romeo, I'm really sorry. We don't understand crypto. Crypto is volatile. It doesn't matter that these funds have all of this amazing track record and, almost never lose or never lose. We all know what happens when you have all of this performance. Basically, you're in for one, which if you actually dive deeply into the nature of the collateral itself, are all responses that don't make sense. And so what I soon came to realize was that alternative assets as a whole, so things like hedge funds or private credit or private equity, any alternative asset, it was really difficult to get appropriate financing on that asset in the real world. So at your bank or some centralized lender. And the reason ultimately is due to the centralization of this servicing, because the bank acts both, as the custodian, but also the lender and the liquidator. And banks are not very agile, but also maybe have some regulatory restrictions in certain things that they can do. And so what I soon came to realize was that the world of tokenization and modular lending, actually, in DeFi, were creating the conditions to allow for what might look like alternative asset financing on chain. And this is where 3F comes in, because what Sonya and I are building is a product to address this market. We're effectively allowing users to get leveraged exposure and therefore financing on alternative assets like crypto arbitrage vehicles and other alternative yielding products in one go, right? They get that exposure in one go. They get that financing in one go.
I think my firsthand experience with holding Athena SUSDE and using that as leverage and looping it, my experience, my understanding, and I think where the disconnect is with these different liquid funds that, are not tokenized, that people want access to, and they want to be able to amplify those returns. The issue that you're calling out is, one, there's a manual process to getting exposure to those funds. Two, they're not tokenized. So I can't just take a representation of my position and then borrow against it on chain. And three, everything I just mentioned creates a challenge, a hurdle to me getting leveraged exposure. If I do it the way that Romeo mentioned doing this with some of his portfolio, it's going to take me potentially months, maybe even years to build up a position. because I'm like borrowing money from the bank and then going back to the fund and depositing more money and so forth. Am I getting all of that? Is this like the reality of an investor today who wants leveraged, amplified, looped exposure to a delta neutral fund like Abraxas?
In the real world, it's not possible, unfortunately. Which is even worse. Even if you wanted to recursively loop it with your bank, they just don't let you. So the only way that we can do so, at least currently, is on-chain, is through DeFi primitives, because we can circumvent these banks. And if we bring enough stakeholders together, we can essentially build the system needed to facilitate the service that you require. In this case, it's getting leveraged exposure on some yielding product.
I mean, just to give a little bit more context as to where we are in the real world today, we had the pleasure of meeting a friend who worked at the debt desk at one of the largest banks in the US. And they would lend, to the likes of Blackstone or Citadel, these like large investment managers who, kind of want to do the off-chain version of what 3F is enabling the users to do. And first of all, this bank, average check size is 250 million. So they're only interfacing with large clients, not like small fry like you and me or Romeo. And secondly, they won't even lend against IBIT, the BlackRock iShares Bitcoin ETF. So, if they're not lending against IBIT, if that's not allowed as collateral from their clients, then there's no way that, for instance, the Abraxas tokenized fund or some, crypto delta neutral fund can be admitted as collateral by these banks. So, as Romeo said, the market does not exist, even though there's these, long tail of holders of awesome investment products who would love to free up, some financing options against that collateral. On the on-chain side, we actually have the opposite problem. There's lots of lenders, lots of liquidity that's looking to earn yield, because stable coins grew, to be a big market cap. And of course, all of this, USDC and USDT is looking for yield. But the yield sources that we've got are very limited. I think Athena was one of the big innovators here, trying to port over the basis trade to on-chain seekers of yield. But beyond that, we've yet to really explore the different possibilities of where the stable coins, I don't know what the latest figure is, say, 250 billion of cumulative stable coins minted on-chain could park to earn yield. So 3F is all about, bridging the two worlds of, on-chain stablecoin holders who want juicier yield than, say, just over collateralized lending or even Athena. And then on the other side, these amazing funds and fund managers who are able to generate yield, but their LPs or holders of that vehicle cannot release financing against that underlying collateral.
Yeah, this is really starting to hit and connect more for me. So, what Romeo talked about earlier, you can't just do this off-chain in the off-chain world. You can't just do this in the fully on-chain world as it stands today. You literally need to bridge these worlds together. To me, this tokenization element is the most immediate hurdle. And I'm curious which funds are making this decision to be this early trailblazer and saying, hey, let's tokenize because we see a huge opportunity in DeFi. Like, who are these funds? What are the archetype of these funds that are trying to be early to this this kind of gold rush on chain?
Over the last 6 months or so, you've seen the emergence of these arbitrage funds looking for a way to essentially have a tokenized representation of their strategies on chain. And this has primarily occurred through Midas and super stakes. And this unlocks a lot of value because it brings, what is off-chain onto the blockchain in a composable way, which you can integrate into all the beautiful lending protocols that essentially create the value in the system. And we expect that a lot more of the funds that are doing similar things to the ones that have already sort of come into the space are going to follow. And I estimate that in the next 12 to 18 months, you will see every arbitrage fund in crypto that is open to investors tokenize in some way and come on chain. Ultimately, what they're realizing is that DeFi is one of the most powerful distribution channels for their strategy. Due to essentially demand for leveraged access, these strategies can scale from tens of millions to hundreds of millions in AUM in a very, very short time. The MF1 fund on Minus from Bolsonaro, I think, scaled to 150 million just in a few months. And this is not something that's very usual in the off-chain world, and proves the power and potential of on-chain distribution. What I am yet to see in the space, other than with the USCC fund actually from Superstate, is I think a true tokenization of the underlying vehicles, rather than having a tokenized note in the way that I think Midas have been doing. I think the most powerful and pure thing to do is tokenize the underlying shares of the real fund. And I think this is the direction that we'll be going in. And I expect that the next funds that do come on chain will look to really bring their pure representation onto DeFi.
And I think this is a pretty interesting, it seems like a minute point, but it's actually a very important point. If you look at how DeFi functions and all the different stakeholders that are required to, for instance, allow leverage on these types of collateral, then we need to bootstrap a healthy ecosystem of liquidators. And if you're a liquidator trying to liquidate someone's levered position against these types of collateral, then you definitely want property rights and legal recourse on the underlying. And in that sense, I believe that the likes of Superstate have done a really good job tokenizing the actual underlying security rather than using some other methods to allow the yields to be ported over to on-chain. If you think about the premium, the liquidation premium that the liquidators need, that's minimized by the ability to, recoup the underlying shares that you've actually been able to liquidate and possess. So, we've been very impressed, for instance, by the Superstate guys who've not only been able to tokenize the underlying shares in a neat way, but through the USCC crypto carry fund, they've negotiated with the fund admin to allow for T+1 settlement. So it's not quite atomic, but it's a fund that allows for T+1 redemptions, which for crypto, the ability to mint and redeem as quickly as possible is so important. So from a fund mechanics perspective, we've been very impressed by what they've been able to achieve.
Let's walk through an example using Superstate, that one tokenized fund that we've been talking about. Maybe tell us the yield on that fund, and then can you just take us through how this would work with 3F, kind of a step-by-step process, what actually happens, just to make sure listeners understand what the end output of 3F's product is here and what it can do for these. Basically, they sound like allies to you, the Superstates of the world.
So the yield on the USCC fund is varied in time. They do a trade which is really popular in centralized arbitrage. They go short the CME term future and they buy the spot at the same time, locking in the premium at which the CME future trades at, which is what we call the basis. And you wait until the end of the month where the term future is priced basically in line with the spot, and then you close the position and you realize that premium over the month. And this yields between like 8 and 20%, depending on the coin and the day at which you look at it. And you can essentially keep on doing this month after month after month after month. Of course, sometimes it's not very useful to do this trade because maybe the implied rate is something like 4% or 5%. And at that point, you just put your money in T-bills. But I'm pretty sure that they do that. So from the 3F standpoint, the way in which we would look to integrate funds or assets of this kind would be by essentially integrating it into our vault and allowing our users to, at their discretion, choose with what leverage get access to that underlying yield product. And what happens is that they deposit some principal into the vault, all done on chain, all done, all done on the blockchain. And we build a leverage position in that underlying for them, where at the end of the process, the user, with one click, now has leveraged exposure. And if they'd like to unwind it, it's just the same process in reverse. They indicate how much they'd like to unwind, and we unwind it all for them. The beauty in what we do at 3F is that we don't recursively loop, because, as Sonya said, with Superstay, it's a T+1 settlement. It would take us, 30 days to get to something like 5 times leverage. And no one wants to wait 30 days to enter the position or 30 days to unwind the position. It's a really illiquid trade and not very profitable for the amount of commitment and time that it takes. So we've designed this facility all on chain to essentially allow for this pool of institutions to extend bridge financing all through our platform, which we invest alongside the principal of the user and build the end position in one go. As soon as we receive the tokenized representation of our subscription, we immediately collateralize it in a DeFi lending market like Morpho or Aave. We borrow stable coins and we repay that bridge facility. And because this happens all on chain, it's incredibly transparent and visible and allows for all of these stakeholders, the user of our platform, the institutions extending this bridge facility, the lenders in the Morpho market, the underlying yield product issuers themselves, all to have visibility and therefore verify, not trust, that this system operates in the way that it does. And what we've done is now create a channel for immediate leveraged access, which is really powerful.
Just to touch on this, neat mechanic that 3F is incorporating, the on-chain, the prime brokers who are providing this bridge loan. I really like this design because, for the longest time we've imagined DeFi copying TradFi, but this mechanic is actually originated from DeFi, which is a flash loan, right? We have the ability to borrow and repay intra-block, but with RWAs, we have now longer duration assets that are needing to tap into this sort of flash loan. So imagine if a flash loan was not intra-block, but it was rather, 2 weeks or 3 weeks to be able to allow the user to, bridge the duration difference between on-chain and off-chain.
River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using SAT-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions with battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs. Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi. So the net result of depositing your money in 3F in the future, once the protocol is live, is I'm getting a tokenized representation of my holdings in these liquid funds. Sounds like multiple liquid funds would be involved. And I end up with like a 5x leverage looped type position. So what is the estimated APY? Are you comfortable to give any forecast of what we might expect?
We know as investment professionals, you should never give an investment yield forecast or return forecast, but it's really up to you, and your risk appetite. Our thesis at 3F is that not all assets employ the most optimal amount of risk for every user. Every user should be able to express his or her own preference for leverage. So the 3F vaults will allow for this exactly. So DeFi dad, if you are, a pretty degen DeFi dad and want to lever up on the, USCC superset USCC fund by 20x, then perhaps you should be able to do that. And our protocol, generally would allow for people to be able to express their preference for leverage. We do have a responsibility of course, working with risk creators on Morpho, for instance, to parameterize each collateral in such a way that the lenders against that asset won't, incur bad debt, or at least the risk of bad debt would be minimized by the well-functioning of the ecosystem, including, as mentioned, a healthy network of liquidators. But we believe that, within USCC, if they do employ leverage, it's not necessarily the optimal amount of leverage for everyone because everybody has a different risk tolerance and risk appetite. So it's really up to the users of 3F whether they want to go 2x leverage or 20x leverage on their asset or collateral of their choice.
So this is not a one-size-fits-all single token like what we have with SUSDE. That trade is all automated and everyone's holding the same exposure. They can choose to go loop that exposure if they want themselves. In this case, when we get onto the 3F front end, we are opting to potentially loop that yield and hold 2x exposure, let's say, or you gave the example, maybe 20x. I mean, it's like perps for these liquid fund yields that are available.
Yeah, precisely. If you go on Hyperliquid, you have the ability to dial up or dial down on your leverage preference. And we believe that the modular lending markets allow for this sort of trade, but on a variety of different collateral, not just tokens.
Well, I would just like to note that this is not actually like a perpetual swap or something similar. You really are going leverage long the underlying in our system, so the spot effectively. Just like on Binance, you can go margin long, Bitcoin or ETH or something like this. This is effectively what we're allowing you to do, but instead of the underlying being a crypto asset like Bitcoin or Ethereum, it's a yielding product, an alternative asset, something that doesn't have instant liquidity.
And you asked about the what sort of yields users can get earlier. So just to make that a little bit more constructive, without predicting future performance. Let's say you have an investment product which yields 15%, like a crypto arbitrage fund, and you're longing that asset and collateralizing through our 3F protocol. And let's say the borrow rate against that collateral is 7%. So you've got 8% spread to play with. Let's say you lever it up 5x, then the math would suggest that you can get real yields, and these are real yields with no token incentives above 40%. So we feel that through our protocol and what we enable our users to do, we can deliver the highest DeFi yields on chain without any token incentives or any funny business. And that's, the kind of the most compelling opportunity for us to target slightly higher risk seekers on DeFi. I think when it comes to over-collateralized lending, we've, as an industry, worked really hard to solidify, the key players here who have been tested through multiple cycles and liquidations. So, the likes of Aave, Euler, Morpho come to mind. But now the question is, now what? What more can we do? The way I think about it is, on the risk spectrum, we've already dominated as an industry senior tranche, senior yields that are dependable, that are low risk, but still very compelling for savers or holders of stable coins. But as we go down the capital structure or go up the risk curve, there is not really any representative asset or representative protocol that delivers those types of jazzier yields. And this is where I personally see 3F innovating on. And the design space is very open, and we're very excited to be releasing our product in the next few months for the higher yield seekers in DeFi.
Just kind of curious if this is more for, RWA-like products, or can you take a product that just already exists on chain, for example, a yield-bearing stablecoin, maybe it's netting between 10 and 15%. Is that something that people could come and use 3F for as well?
Yeah, absolutely. I think one of the interesting things as we look forward, like beyond crypto arbitrage funds or, like alternative credit funds or assets, like what can we bring on chain and allow users to get leverage exposure on? One of the things that was suggested to me by an interested VC was, what about infrastructure and energy? Infrastructure and energy in the TradFi world are assets that can take on a lot of leverage because they have a very ideal, high cash generative, low volatility profile. So anything that, has, for instance, 15 to 20% quite stable cash flow generation profile, we want to incorporate into 3F. And without naming any names, or, in the last few months, really interesting crypto native projects that have been funded to bring these assets and cash flows on chain. So we're also in the early stages of discussing potential collaboration between these infrastructure and energy projects, which, to DeFi users will be music to their ears.
Guys, I think this is a great place for us to start to wrap up. So I want to remind our listeners that they can learn more about 3F by going to 3f.xyz. They should follow 3F Labs on X, follow Sonya Sun Kim on X, that's her personal handle, and then follow Romeo at 3F_Romeo. Thank you both for coming on. Before you go, any ETA on when this might be live and any other final word for us?
Yeah, we're busy building this infrastructure for future users. So keep an eye out for a Q1 launch.
Yeah, thank you so much for having me, guys. It was a lot of fun. And I'm excited to continue this journey with all of us together.
And DeFi Dad, there's a wait list that you can, enter your email address in. So, looking forward to having you guys as future users of our protocol too.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.